traders, and welcome to the market review on your midweek, October 14, 2020. Today we take our time to look at developments in the private equity and venture capital space, so we would be going straight on. For today, we'll be looking at regulations in the venture capital space in Nigeria. How do regulations help to improve venture capital activities in countries like Nigeria? That will be our focus. But let's first share with you what we'll be discussing today. First of all, we'll be looking at trends to watch in the venture capital global space, particularly in a year that has been shaped by the COVID-19 pandemic, factors that are helping to improve VC activities. Also, we're looking at the Association of Bureau de Change's operators in Nigeria. They want the Central Bank of Nigeria to raise liquidity ratios. And finally, Union Bank and International Finance Corporation have agreed a $40 million facility funding partnership. So let's get on to the conversation. The trends are there, and these are the things for anybody to follow. What are the trends that are affecting or impacting venture capital activities that we'll watch out for this year amidst the volatility in the crude oil price and commodities market, and of course the COVID-19 pandemic? The first is that RegTech will gain prominence. The last few years have seen a monumental increase in focus on privacy regulations. In the wake of data breaches, privacy concerns, and sweeping regulations such as the General Data Protection Regulation, GDPR, it's a top mind for every business to look at it from shape and size. The increased fixation on regulation concerns has understandably stimulated heightened demand for tools and technology that enable companies to adhere to complex regulatory requirements. It is expected that this category of tools and technology, RegTech, will play a prominent role in venture capital funding in 2020. The next area to explore in terms of the trends to watch for the year 2020 in terms of RegTech activities. Further data has shown that according to Research Forrester, RegTech grew a staggering 103% year-on-year in the first 3 quarters of 2019. What's more to understand is that Forrester predicts that RegTech funding will double again in 2020. Some of the RegTech movers and shakers include Rubrik, a Palo Alto-based unicorn that's built a single platform for users to surely and securely manage all their data in the cloud, and Verafin, which is an industry leader in financial crime management. The second trend is that Seattle in US will solidify its position as a venture capital hub. We're hoping that for Nigeria, but at least Lagos. In terms of venture capital activity, Seattle has long lived in Silicon Valley's shadows. Things began to change, however, in 2018 when Seattle's VC firms raised more new funds than they had in 10 years. Seattle's rise to venture capital stardom can be attributed to many factors. Companies such as Dropbox, Facebook, Uber, and Stripe have established offices in Seattle. Top-tier talent has flocked to the region, and that is what is really making it happen. What's more there is that the University of Washington has bolstered its reputation as an elite university in recent years, providing an important source of startup talent. While Seattle's startups are notably still struggling to raise seed-stage funding as compared to their counterparts in other venture capital hubs, there are many signs of progress. Some of Seattle's most promising startups include digital freight network Convoy, which has secured investments from Amazon's multi-billionaire Jeff Bezos, among others. There's fintech company Remitly, which enables users to make person-to-person international money transfers, and Modus, which aspires to be the operating system for all real estate transactions. Keller & Carter partner at Bellevue, Washington-based Ignition Partners, an early-stage venture capital firm specializing in enterprise softwares, is one of many venture capitalists who has high hopes for Seattle's prospect of becoming a key VC hub in the globe. He has predicted that in this year, there will be a record number of growth stage financing in Seattle, seeding the next phase of software unicorns. And lastly, artificial intelligence will continue to dominate VC interests. So all of you there doing AI, just note that you will continue to attract more investments. Interest in AI has reached fever pitch, according to a recently released 2019 AI Index report. It is now the most popular specialization for computer science PhD students. In 2018, an impressive 21% of graduate students specialized in either machine learning or AI. What's more, from 1998 to 2018, peer-reviewed AI research increased by 300%. Venture capital has endeavored to stay abreast of AI progress and talent. And this is very important. By the CB Insights, in terms of analysis, artificial intelligence startups raised a record $26.6 billion in 2019. This represented more than 2,200 deals across the world as compared to 1,900 deals totaling $22.1 billion in 2018, and approximately 1,700 deals totaling $16.8 billion in 2017. You now know why AI is the big thing. What will be the factors for improving venture capital funding? It's very important because VCs across the world continue to assess the situation and see how they can invest further. First is more access to capital is very important. The emerging consensus is that liquidity will be relatively scarce, at least up till 2021. Investors will take more time to decide on deals, and in an expert's view, there could be a lot more ghosting. But early stage VCs are optimistic about what can be achieved in the months ahead. Let's take example in Nigeria of Dayo Kolewo, a partner at Microtraction, a Nigeria-based firm with interest in Cowrie Wines, Bicons, and BitSeeker, among others. He says there will be no significant difference in his firm's startup investment protocol. The stage we play in by default requires thinking long-term as well as investing in founders that can adapt in unusual situations, he said to Tech Cabal, the source of this information. Another very major area is that in February, the firm engaged 7 venture scouts, a team of 7 unpaid, non-exclusive ecosystem analysts to help them find attractive deals from around Africa. A month later, they increased their standard deal size from $15,000 to $25,000 and reduced the percentage they take from 7.5% to 7%. Very interesting. There's one name that resonates with everybody when it comes to venture capital activities. His name is Inyaboyeji. You know him for Flutterwave, but there are other things he's involved in. Inyaboyeji is testing a new model of crowd-funded VC investing. Instead of the private equity standard, where a limited partner network of investors handed over funds to a VC firm to manage, Aboyeji is now piloting a co-investment model. With minimum of $10,000 and subject to meeting other criteria, anyone can have access to a pool of investments available to Future Africa as a group. Contrary to the limited partnership model, a co-investor can invest on a deal-by-deal basis. The new fund will invest up to $50,000. Those are interesting things we're seeing in the VC space. In a setup for less than 11% equity, the plan to close 5 deals per quarter. Aboyeji, who founded Andela and Flutterwave in the years surrounding Nigeria's 2015 recession, is one of the big rising stars in the tech and VC space. In a way, he's towing his line to validate a belief that innovative African companies can and will arise from times of crisis. People who found companies during downturns are not performance entrepreneurs, but just trying to raise money. But more people who will remain passionate about what they build is what Mr. Aboyeji said. Appealing post-pandemic factors or sectors are becoming very important at this time. And that is one thing that all the VC firms and experts are taking seriously. Maya Hogan Famodu, Ingressive Capital CEO, believes the new market opportunities will evolve in line with any changes in how consumers use technology that will depend on how the pandemic and its effects last. Ingressive typically targets 10% ownership in companies, and the ticket size average is $200,000. They participated in the big deal, the 54 Genes recent series, partly because the health sector is growing significantly in emerging markets with the potential for a 10-digit plus exit, she told Tech Cabal. Health tech has certainly come to the fore over the last 4 months because of the COVID-19 pandemic and effects. Kolewo expects Microtraction will slightly be more inclined towards sectors that can fully benefit from the present crisis and successfully wade through it. For her, so sectors that I feel might be positioned for the future with respect to attracting customers and also capital will be remote training, decentralized collaboration, remote medicine, food production, and distribution, to mention a few. Microtraction made other crucial moves in the pre-pandemic period by entering a strategic partnership with Goldbond Road Advisory, a Lagos-based private policy firm. They provide regulatory compliance advice to microtraction portfolio companies. Both parties began conversations for the regulatory consultancy in November 2019. It's a need that could become vital for companies in a post-pandemic world filled with extra regulatory caution and uncertain investors holding on to their hard cash. Before the coronavirus menace, the hot button issue in Nigeria tech has been around the ban on motorcycles in Lagos. The abruptness of that event, which affected bike-hailing companies in drastic ways, highlighted the unpredictability of investing in Africa. No investor wants to get into an environment where political risk raised the barrier to success. With the pandemic in play, health-related risk factors will be front and center in investment talks across deal rooms. Founders in contact-based industries like hospitality, outdoor events, and entertainment appear to have their work cut out for them. Yes, really. Investors are loath to completely dismiss these sectors at the moment, but don't hold your breath yet, because for shape-shifting announcements, anything can still happen anytime soon. The Association of Bureau de Change Operators in Nigeria, APCON, has called on Central Bank of Nigeria to consider raising the liquidity ratio of banks to discourage foreign currency holding. According to the association, this would increase the availability of forex, especially for the purpose of increasing liquidity at the official retail segment where BDCs operate. In its quarterly economic review report for third quarter of 2020, the association warned the Central Bank of Nigeria against pegging interest rates and other variables, saying it could lead to a faulty system. The association charged the Monetary Authority to intervene in selected priority sectors through incentives, saying it would aid the smooth flow of the whole economy, especially when complemented with fiscal management efforts. Stressing the need for the Central Bank of Nigeria to address the huge exchange rate mismatch in the forex market, APCON said it's imperative for the Monetary Authority to actively participate with precision through market-level interventions. Volumetric interventions and demand-push exchange rates must automatically influence the market in direction the authority desires. According to them, it is illogical to intervene in the market at 380 naira when the open market is moving at 460 naira. Who takes the margin, they ask. This is an exchange rate mismatch. The solution, according to them, is not throwing millstones or blackmailing any subsector of the market. The margin ends in one market and is functional to the volume to satisfy market deficit in supply. It called for increased cooperation among BDC operators to attract autonomous foreign exchange inflows, facilitated by the reopening of the economy. Operators are set to make windfalls as foreign currency areas coming from the long business lockdowns are reopening. Traders, through cooperation, can attract huge autonomous foreign exchange volume through interplay of time exchange rate margins from the liquidity in the open markets. The association also warned against increasing the retirement age, saying it would work against the policies put in place to reduce youth unemployment in the country. APCON says position was against the background of recent decision of the federal government to increase retirement age of teachers from 60 to 65 years. According to the report, increasing the workforce retirement age will be counterproductive under the conditions of high youth unemployment rate, urging the government to instead prepare solid post-retirement facilities and promote policies to reduce youth unemployment with a view to addressing social unrest. It maintained that recovery from severe impact of COVID-19 pandemic on the nation's economy would be determined by structured and people-oriented policy aimed at resolving the macroeconomic imbalance arising from the disruptions. Also, the association said the federal government should put in place post-retirement facilities ahead of increasing retirement age and direct spending towards business recovery, poverty elevation, and infrastructure. Those were very clear thoughts from APCON on what should be done from Central Bank of Nigeria. Let's also tell you that the Union Bank has announced its partnership with International Finance Corporation, a member of the World Bank Group. The partnership will enable the bank to receive funding facility worth $40 million from the group, targeted at boosting access to finance for local businesses, increasing international trade, and helping to protect the nation's economy from the accompanying harsh impact of the pandemic. The partnership is under the IFC's Global Trade Finance Program, GTFP, and as part of the terms of its arrangements. It will offer the confirming banks partial or full guarantees covering payment risk on Union Bank's trade-related transactions. The guarantees are transaction-specific and are backed up by a variety of underlying instruments, including letters of credit, trade-related promissory notes, guarantees, amongst others. Commenting on the partnership, the Chief Executive Officer of Union Bank, Mr. Emeka Imowa, stated that Union Bank is pleased to join the IFC's Global Trade Finance Program. This is a significant achievement as it continues to expand the trade offerings to corporate customers. Commenting further, he said, Even in these peculiar times, we remain focused on contributing to economic growth by developing tailored solutions that help our customers harness the teeming opportunities that still exist in the Nigerian markets. Union Bank had also announced its partnership in this regard to help boost its activity. As we wrap up, let's look at regulation. Today's topic is regulation in the venture capital space. It is important to note that over $200 billion is prospects of investment this year across the world, and Nigeria must be one of those hubs to attract this investment. Thereby, regulation has to become a very key issue that is given top priority. Apart from the CAM Act, which is a welcome development, and the Finance Bill, there needs to be synergy amongst all regulatory authorities to ensure that venture capital investors do not have hitches when trying to make headway in the deals that they carry out. In that regard, there's the first area of importance and priority should be synergy among key financial regulators. The Security and Exchange Commission, the Central Bank of Nigeria are very important. The synergy between those two is critical, ensuring that all the processes that enables guarantees of investments, all the processes that enables effective documentation are carried out to ensure that investments are safe and that there's no concern of uncertainty. On the part of the Central Bank of Nigeria, we always speak about the second aspect, which is stability in monetary policy approach. Areas like the foreign exchange management is a major concern again, and we have continued to raise this, and we know that the Central Bank of Nigeria is doing their best, but we also want to emphasize this as very important because it helps to attract investments. The third area of concern is the legislations. Over time, we need to periodically look at our legislations as a country as it concerns ability to attract more private capital investments, especially venture capital investments. So National Assembly, the Finance Committee, will look at how to improve institutions and make them efficient, and also improve enabling laws for business environments to improve. And so in that regard, it's very critical that the Senate Committee and the House Committee continue to explore ways they can improve legislations for the attraction of more private capital investments. On the part of the government, the roles of the Ministry of Industry, Trade and Investments, the synergy between them and the Finance Ministry is very important for fiscal alignment to ensure that investments, or we can become that hub to be attract at least every year targets at least $1 billion every year. That should be a big target. And to do that, the fiscal alignment must be there. The monetary policy alignment must also be there just to attract this kind of investments. In different sectors, we have the Corporate Governance Code. The Financial Reporting Council of Nigeria is the driver coordinating a body for that. So for venture capital players that want to look at various sectors for investment, it is important that the various regulators in that regard take seriously their role. From insurance, where you have NICOM, the National Insurance Commission, even down to investments in the energy markets, the National Electricity Regulatory Commission, even down to activities in the petroleum sector as we continue to seek more clarity in regulations in that space. Any venture capital firm that seeks to invest in oil and gas should be able to look at the PIB and be optimistic that this is one document that will help guarantee investments. Also, this will apply to even the capital markets, like we said, ventures, activities there, require more proactive steps from the Security and Exchange Commission and others, the self-regulatory organizations in that regard. The financial markets, the capital markets, and generally the economic space must continue to understand that regulations are very important. Institutions also play a very key role. Nigeria must value the role of institutions and ensure that people are not powerful than institutions. Venture capital firms will continue to invest in climes that have strong institutions and effective and robust regulations that are proactive and dynamic. That will be all for this edition of the Market Review. You can visit our website www.prochanging.com to watch our videos with our news reports and analysis. Do send your views on regulations and venture capital activities in Nigeria to news@proceed.com. We will receive it gladly and respond appropriately. Let's make this happen again tomorrow, 10 a.m. same time. To come your way again, thank you for watching. Have a nice day and stay safe.